Anyone reply yes, sir, so that I will start the session?
Yes, sir.
Yes, sir.
Okay, perfect. Okay, good morning to all of you. We will start with the recap of the previous problem, what we have solved. See, in the previous problem, we discussed about a problem wherein we need to calculate the portfolio return and portfolio variance. Now, as you usually mention, portfolio return is symbolically written as sigma p or standard deviation of the portfolio. That is, risk is concerned. Portfolio return is RP, and similarly, portfolio variance is sigma p square. Okay. So, in the previous problem, which we already discussed, they had given me four stocks. They had given me alpha, beta, and the residual variance called as EI square. And you can see here, see my cursor, they had given me market return, that is RM, which is equal to 11, as well as market return variance. Please understand this symbol, market return variance, sigma m square, which is equal to 26. So given all these data, we are supposed to calculate the portfolio return RP and portfolio variance. Now what we did for that, first we calculated individual securities return using alpha plus beta into RM. So they have given me alpha value of each stock, right? So 0.17 is for the first stock, and beta of the first stock is 0.93, and the residual variance of the first stock is 45.15. So they have given me all these values. Now, similarly, using all this data, I have calculated R1, that is for the first stock, and R2, I got 17.55. And then R3, I got 20.5, and R4, that is 15.4. So first step is what? I have calculated the returns of individual security. Then after that, what I have to do? See the question here. They have given me the investment is spread equally over the stocks. So since there are four stocks, and when they have mentioned equally over the four stocks, so what is the proportion here? 25% in one stock, 25% here, 25% here, and 25% here. Wait, let me see. Someone is waiting. Multiple. 1 minute. Wait. Admit. Okay. Still. Okay. Now the next step is what? Calculation of variance of the portfolio, that is sigma p square. I use this summation of I is equal to 1 to n. X1 is the proportion of funds invested, and beta of beta whole square into variance of the market, plus summation of I is equal to 1 to n, x1 square into EI square, that is the residual variance, right? See, I have written here sigma m square is what? Variance of the market or variance of the index. Then EI square is what? Residual variance. Now students, what we did was in the previous class, we solved this first, that is summation of I is equal to 1 to n x1 into beta 1 whole square. Then we solved this part, that is x1 into x1 square into residual variance. So first what we'll take, we will solve this. See, as we have mentioned in the problem, as they have mentioned in the problem, 0.25, that is the proportion of funds that has to be invested in each security should be equal. So since there are four securities, what I'll do 0.25 into 0.93. From where this 0.93 came, they have given me, all of you see here in the question, 0.93 is the beta of the first stock, 1.37 is the beta of the second stock, 1.73 is the beta of the third stock, and 1.17 is the beta of the fourth stock. They have given, right? So using that, I apply here 0.25 multiplied by 0.93 plus 0.25 multiplied by 1.37 plus 0.25 multiplied by 1.73 plus 0.25 multiplied by 1.7 whole square. So I got 1.69. Now it doesn't stop here. So what is there in the formula? Summation of I is equal to 1 to n x1 into beta 1 whole square multiplied by variance of the market. See here in the problem, all of you, they have given, right? Market variance is how much? 26. They have given. So now what I'll do, I multiply it by 26. So I get 43.94, right? So I got the value of this part, this part. Now, the problem doesn't stop here. I need to still calculate what? I need to still calculate the second component here in the formula, that is x1 square into EI square. That is proportion of funds that has to be invested in each security multiplied by EI square is what? Residual variance. Now, when I take that 0.25 square into residual variance of the first stock, 0.25 square into 132.25 plus 0.25 square into 196.29, right? Plus 0.25 square into 51.98. I got 26.606, the value of the second component. Okay. See, I have calculated first this, then plus this value. Okay. So when I add these two, I got the variance of the portfolio to be equal to 70.546. Now, what is the standard deviation of the portfolio? Standard deviation of the portfolio is equal to square root of 70.546, which is equal to 8.399. So what they have asked me in the question to calculate, students, first see here, all of you, they have asked me to calculate the portfolio return. Have we calculated the portfolio return? See here, RP is the portfolio return. We got 15.965. Then what they have asked me to calculate, see the question here, portfolio variance. How do I symbolically write portfolio variance? Sigma P square, right? So whether we have calculated sigma P square here, yes, sigma P square we have calculated. We got the value to be equal to 70.546. So though in the question, they have not asked me to calculate the standard deviation of the portfolio, but for your understanding and explanation, so we have solved it. Sigma P is what? Very simple. Square root of 70.546, which is equal to 8.399. So this was the problem what we had discussed in the last class. So till here, everyone has understood the previous problem, so that I can go for the next problem, students. Yes?
Yes, sir.
Perfect. All of you are solving, right? Immediately after the class, I request you all to solve once. Okay. I think no one is waiting. We'll go for the next problem. Now, the problem what I'll be taking now today, students. So construction of optimum portfolio, I am telling you, this is a very, very important problem. It will be normally given for the case study. Okay. And it is also one of the, the problem is concerned for solving. It takes a lot of time also, because we have to go step by step. So what they have given me, we will understand. Then we will go for the problem. Okay. Mr. David is constructing an optimum portfolio. Now, when I say optimum portfolio, all of you know the meaning of portfolio, right? Now we will understand what is optimum portfolio. Optimum portfolio is a term used in the portfolio theory to refer to one of the portfolio on the efficient frontier with the highest return. Please understand, with the highest return to risk combination given the specific investor's tolerance for risk. And it's the point where the efficient frontier, that is supply, and the indifference curve, that is demand, they meet each other. So according to Markowitz theory, students, there is an optimum portfolio that could be designed with a perfect balance between the risk and return. The optimum portfolio does not simply include securities with the highest potential returns or low securities. So the efficient frontier is the set of optimal portfolios that offer the highest expected return, okay, for a defined level of risk, or the lowest risk for a given level of expected return. So that is how we construct the optimum portfolio. Now what they have given in the problem, Mr. David is constructing an optimum portfolio. The market return forecast says that it would be 13.5% for the next 2 years with the market variance of 10%. The riskless rate of return is 5%. the following securities are under review. We need to find or construct the optimum portfolio. Now remember students, please understand this problem. They have given me the 5 companies here. We need to construct the optimum portfolio. We should also, when I say construct the optimum portfolio, we should even find out how much proportion Mr. David has to invest in each stock so that he will get a decent returns. Understood? So they have given me in the problem 5 stocks. What we are supposed to calculate is we have to construct the optimum portfolio first. And the second thing is we need to even find out how much proportion of funds has to be invested in each security. Clear? Now, what all parameters they have given, can anyone list here in this part, only in these 3 lines? You don't tell me about the table here, alpha, beta, and sigma A square. You don't tell me this. But what they have given me in these 3 lines, can anyone tell me? Explain me. Yes. Students, the market return forecast says that it would be 13.5% for the next 2 years. The market return forecast. So what is that market return? Symbolically, how do we write that as market return? Yes, anybody? RM is equal to 13.5%, what they have given. RM, okay? Market return. Then market variance, what they have given me in the problem is 10%. See here, market variance is 10%. So how do we write symbolically market variance? Hello, students. How do we write market variance symbolically?
Sigma M square, sir.
Very good. Sigma M square is how much, ma? 10%, what they have given. Then what they have given, RM, that is 13.5%. The riskless rate of return is how much? 5%, that is RF. See, whenever I am saying this, please remember this. Okay? So what they have given, RM, 13.5%. Then sigma M square, that is 10%. Then RF, that is the riskless rate of return, RF is equal to 5%. So using all this information, we have to construct first the optimum portfolio. And then second thing is, we need to even calculate the proportion of funds that has to be invested in each stock. Okay? How many stocks are there in the problem? 5 stocks are there. So we need to even find out what is the proportion of funds that has to be invested in each stock, right? Let me go for the solution for this. I request all of you to open up your calculator and even the notes also, because a lot of calculation part is there in this particular problem. Okay. Now students, please see your solution is concerned. Expected return for the individual security should be found out using RI, that is the return of the stock. RI is equal to alpha plus beta into RM. All of you know they have given me alpha, then beta, then sigma A square, which is the residual variance, right? So for the first stock, how they have calculated? 3.72 alpha plus beta, that is 0.99. What is RM? Whether they have given? Yes, they have given, right? That is 13.5. Similarly, for the second stock, RI is equal to 0.6 plus, see here all of you, for the first stock 3.72 alpha plus 0.99. 1 minute, sorry. Yeah, see here now. RM remains the same for all the stocks because that is the market return, right? That is 13.5. Similarly, AVIL, that is 0.6 plus 1.27 into 13.5. All of you, please solve this and tell me any difference is there, okay? Then the third company is concerned, what we are calculating now, individual stock returns, okay? Alpha plus beta into RM. Alpha is 0.41 plus beta is 0.96 into RM is what market return, that is 13.5. I got 13.37. Similarly, the fourth stock, minus 0.22. So whether they have given minus, see here in the problem, students, alpha value for the fourth stock is minus 0.22, okay? So minus 0.22 plus 1.21 into 13.5 into 16, which is equal to 16.2. Then the fifth stock is concerned, alpha plus beta RM, 0.45 plus beta, that is 0.75 into RM, that is 13.5. I got the value to be equal to 10.58. So till here, everyone has understood. I request all to speak. Any doubt till here? That is calculation of RI. First step is concerned. Students, this problem is concerned, it is very big, so I am going very slow and step by step, okay? Till here, everyone has understood? Alpha plus beta RM?
Yes, sir.
Yes, sir.
Sir,
Yes, any doubt, ma?
sir, repeat once again, please.
Okay, ma, no problem, okay? So this problem is concerned, they have asked me to calculate the optimum portfolio. So when I use optimum portfolio, when I want to construct the optimum portfolio, I need not only the stocks, but even I need to calculate the proportion of funds that has to be invested in each stock. For example, there are 5 companies. You approach me, sir, I have 10 lakhs, sir. Please construct me an optimum portfolio. So what I suggest you, I'll construct a portfolio for your 10 lakhs, right? Your amount, what you're investing is 10 lakhs, and I'll be constructing the optimum portfolio for that. I'll be giving you 5 stocks, only 5 stocks in the portfolio. Then what I do, I say to invest equal amount in each, correct? So I, for the first, say for example, I give these 5 companies for you. So I said 3 lakhs here, 2 lakhs here, 1 lakh here, 1 lakh here, and 3 lakhs here. So the total should be how much? 10 lakhs, because your amount what you are planning to invest is 10 lakhs. So I will be constructing the portfolio for that amount, that is 10 lakhs, right? So in this problem, we need to even construct the portfolio, and even we have to tell what is the proportion of funds that has to be invested in each stock, so that investor will be getting maximum returns. Now first step is what? We need to calculate the return of each stock, okay? So first I'll take here 1 minute. For the first stock, that is Anil, what they have given in the problem, okay? So how do I calculate the returns? Alpha plus beta into market return. So alpha they have given me, see, that is 3.72. What is there in the table? The second column is concerned is alpha. The third column is concerned, that is beta. And the fourth column is concerned, it is residual variance, that is symbolically written as sigma EI square, right? So what I'll do here first, I solve for each individual security, that is alpha plus beta into RM. I got 17.09. Similarly, for the second stock, 0.6 plus 1.27 into 13.5, that is equal to 17.75. Stephen, what is this 13.5 in the problem? Whether they have given me, what is this? 13.5.
So market return.
Fantastic. Okay, all of you, 13.5 is the market return which they have given me in the problem. Okay. Third stock is concerned 0.41 plus 0.96 into market return. Similarly, for the fourth stock, minus 0.22. Array, why minus? Whether they have given me? Yes, here, minus 0.22. They have given, okay? Alpha value of the fourth stock plus 1.21 into 13.5. Similarly, for the fifth stock, it is 0.45 plus 0.75 into market return, that is 10.58. Now, till here, all of you have understood, right? Someone asked me, please explain. Have you understood, ma?
Yes, sir.
Okay.
Yes, sir. Yes, sir.
Okay, perfect. Now, this is very important. Before going to this table, students, I will explain you how to construct this table, okay? We need to identify, we need to first know this formula to find out the cutoff point in the portfolio. I'm repeating once again, this formula is very important in calculation of optimum portfolio, or to find out the cutoff point. Only if you know this particular formula, Then based on that, we can construct the table what you are seeing in front of your screen. Okay. So what I'll say, first all of you see this formula here. CI means what? Finding of the cutoff point, okay, is equal to variance of the market multiplied by summation of I is equal to 1 to n, Ri minus Rf divided by sigma ei square into beta, okay, whole divided by 1 plus variance of the market summation of I is equal to 1 to n beta divided by sigma ei square. Okay, please see this formula. So what I'll do, students, now is first I will calculate Ri minus Rf. First, what I'll do, I'll calculate Ri minus Rf. One minute. Yeah. Ri minus Rf, and then I'll use the table for that. But students, here is a small thing what we have to do first. Please remember this in finding out the cutoff point. First column, see here I am listing the company. First column is concerned, we have to calculate Ri minus Rf divided by beta. And it should be in the descending order, that is from highest to lowest. We have to arrange these values from highest to lowest. I'm repeating once again. First step after calculating the return, we have to calculate Ri minus Rf divided by beta. So what is Ri value? Please use your calculator and start solving. The first stock is concerned. What is the Ri value? Can anyone tell me? For the first stock, Anil, what is the Rf value? 17.09. We have calculated here. Okay. Minus, what is Rf value? Rf.
5%, sir.
5%.
5, okay, which is equal to 12.09 divided by beta. Beta value is how much for the first stock? Here only it is there, see, 0.99. So how much I got? 12.212. Students, I'm repeating, the first column is concerned, you have to arrange it or rank it, or the sequence should be from highest to lowest. I'm repeating, okay? Anil, then after that I'll solve for Avil. And see here, the order changes here. The reason is it has to be arranged from highest to lowest. I am repeating. See, the stock what they have given me is what? Anil, Avil, Bau, Viril, and Billy. But here, Anil, Avil, then comes Viril, then comes Bau and Billy. The order changes. The reason is very simple. We need to first calculate Ri minus Rf divided by beta for each stock and arrange that from highest to lowest. Okay. So now we will go for the third stock, that is Viril. We will check. Ri is how much for the third stock? For Viril, 16. I'm solving for here, that is Viril. Okay. 16. All of you solve with me. 0.12 minus Rf is how much? 5 divided by beta value for Viril is how much? 1.21. So I got the value to be equal to 9.190. Okay, clear? Then I'll go for the stock. How much? Bow, that is this stock. So Ri is how much? Bow, 13.37. Okay, minus Rf is 5 divided by beta. Beta of Bow is how much? 0.96, which is equal to 8.7. See here, the order has changed there. So you should be, in the examination, you should be very, very careful. Whenever they ask you to calculate the optimum portfolio, the first step is calculation of Ri, and the second step is you need to arrange this in from highest to lowest. So when you are arranging from highest to lowest, the order changes here. Students, till here everyone has understood the first column? If you have not understood, ask me. Yes, students, can anyone say yes, sir, no, sir?
Yes,
Understood?
sir. Understood.
Yes, sir.
Okay, so what we have done here, can anyone tell me? And tell me the first step. We will go step by step. Please speak.
So
Huh.
we had calculate Ri minus Rf divided by beta, sir.
Okay.
Yes, sir. In that, Ri is our uh, the 17.9 for Anil, sir.
Very good.
And-
17.09.
Yes, sir. And Rf
Okay.
is point 5, sir. Only 5.
Okay. Okay.
And divided by beta is 0.99, sir. So we got 12.
0.99 after decimal. Okay.
Yes,
Perfect.
okay, sir.
Ranjit, tell me, explain me.
Yes, sir. After that, we calculate, we got Anil value is 12.212, sir. Like
Okay.
that, we had calculate for others also, sir.
Fantastic. So how the arrangement should be?
It's in ascending order, sir.
Hey,
Highest to lowest,
Oh,
sir. Descending order.
highest to lowest, sir.
highest
Descending
to
order.
lowest is called which order? Ascending or
Descending order,
descending?
sir.
Descending order.
Descending order, sir.
Ascending. Okay, perfect,
Yes, sir.
Ranjit. All
Thank you,
of you
sir.
understood, right? Descending order. It has to be in descending order. That is from highest to lowest. So the second column, all of you have understood. Now we will go to the third column. Ri minus Rf divided by variance, sorry, that is sigma ei square into beta. Why I am using this? Because see the formula here. Ri minus Rf divided by sigma ei square multiplied by beta. Now you should be very, very careful. So what is Ri minus Rf for the first talk? Ri is 17.09 minus 5 multiplied by 0.99 divided by what is sigma ei square for the first talk? 9.35. All of you solve and tell me. So how do I take here? Ri? Ri for the first talk is how much? 17.09 minus 5, okay, multiplied by beta of the first talk is 0.99 divided by what is sigma ei square? 9.35. How much, students? You are getting 1.280. All of you are with me? All of you are solving?
Yes,
Please
sir.
solve. Okay, similarly, all of you, I request you to solve for Avil, Viril, Bow, and Billy. The remaining 4 stocks are concerned. What I have to take? Ri minus Rf into beta divided by sigma ei square. I request all of you to solve this particular column using calculator. The third column is concerned. I'm repeating once again. Ri is what? Individual stock return. For Avil, it is 17.75 minus 5 into beta divided by sigma ei square. Any other value you are not getting, please stop. All of you are getting the same value, students. The third column is concerned. Shall I go to the fourth column, students? All of you are getting the same value. If you are not getting even a single value, please stop me. I'm repeating once again. Ranjit, Stephen,
Yes, sir.
no understanding, right? How you got the values in the third column here?
Yes, yes.
Okay. Now, I'll come to the fourth column, students. Please see the formula here. I'll calculate this beta I square divided by sigma ei square. This one, this part, okay? Now, what is beta I square here for the first talk? That is Anil, that is 0.99 square, huh? Divided by sigma ei square, that is 9.35. I got 0.105. This fourth column, all of you solve along with me. Beta value of each stock they have given, right? For Avil, 1.27 square divided by what is sigma ei square? See here, Avil also they have given, that is 5.92. So for the first stock, it is 9.35, 5.92, 9.79, 5.39, 4.52. Okay. So how I am getting the fourth column? Beta I square of the individual stock divided by sigma ei square of the individual stock. I'll be getting the fourth column. So after solving till the fourth column, how I am getting the fifth column? See here, see the formula here, all of you. Here, summation symbol is there. Summation of I is equal to 1 to n, Ri minus Rf divided by sigma ei square into beta. So already, students, this is very tricky here. Already I have solved here. See here, in the third column, this column is concerned. I have solved 1.280. So I need to summate this. How I will be summating this? See here, 1.280, I'll be writing as it is. Now, 1.280 plus 2.735 will give me 4.015. 4.015 plus 2.496 will give me 6.511. 6.511 plus 0.2821 will give me 7.332. 7.332 plus 0.926 will give me 8.258. Okay, so I'll be doing the summation of this. Similarly, the next column is concerned, summation of I is equal to 1 to n, beta I square divided by sigma ei square. So I need to summate the fourth column, that is 0.105. I'll be retaining 0.105 like this. Now 0.105 plus 0.272 will give me 0.377. 0.377 plus 0.272 will give me 0.649. 0.649 plus 0.094 will give me 0.743. 0.743 plus 0.124 will give me 0.867. Okay, so this is how I am calculating the summation of these two, summation of the third and the fourth column. Students, done? Are you with me?
Yes, sir.
Yes, sir.
Perfect. Now the last column is concerned, directly I have written the values, right? But we need to solve, right? So what I'll do, CI is very important column to find out the cutoff point. I have marked here star. So how do I calculate CI? Please use this formula, students. CI for the first stock, okay? First is variance of the market. So whether they have given, yes, 10 multiplied by summation of I is equal to 1 to n. That is this column, students, 1.280. All of you have calculated this, right? 1.280. See here, the numerator is concerned, 10 multiplied by 1.280 divided by denominator. 1 plus 10 into, what is this? 0.105. Okay, so these two values I am taking here in the formula. See here, the first stock is concerned, 10 multiplied by 1.280 divided by 1 plus 10 into 0.105. So I get the value 12.8 divided by 2.05, which is equal to 6.244. See here the first value. Okay, so I need to find out the C, that is the cutoff value of each stock. Similarly, you need to calculate for Avil, Viril, Bow, and Billy. Okay, so for Avil we get 8.417. Then for Viril we get 8.693. For Bow we get 8.697. See here, students, there are two methods to identify the cutoff point. Please remember, please understand this. You can see here the values are concerned. It is 6.244, 8.417, 8.693, 8.697. After 8.697, I get a value which is lesser than the previous. See 8.5. 8.540 is lesser than 8.697. So what I'll do, I'll not take this value. I will be taking this value as my cutoff point. I'll be taking this value as my cutoff point. Okay. So I'll start here. I calculate CI first. I get 6.244, 8.417, 8.693, 8.697. Then after that, for Billy, that is the last stock is concerned, I get a value which is lesser than the previous one. So this is the highest value or the cutoff point what I'll be taking for this particular problem. So in my portfolio, I am repeating once again, in my portfolio, the cutoff point is 8.697, that is Bow. So I will not go further for Billy. Or you can, some people even say that the highest value can be taken as the cutoff point. See in this, 6.244 is highest, no. 8.417 is highest, no. 8.693 is highest, no. 8.697 is highest, yes. So this value will be taken. Or very simple, the moment you get a value which is lesser than this, so I'll be taking till here as the cutoff point. It is marked as C star in the problem. Okay, C star. So after finding out the cutoff point, next thing is we need to calculate the proportion of stock in the optimum portfolio. Now, one thing what we have identified is my portfolio consists of the first 4 stocks only. The 5th stock I'll not be considering because my cutoff point has stood in the 4th place. Okay. So how do we calculate the proportion of stocks in the optimum portfolio? Proportion symbolically is written as xi, which is equal to zi divided by summation of I is equal to 1 into zi. Now, how do I calculate zi? Please see here, the slide is concerned. Beta I divided by sigma ei square into Ri minus Rf divided by beta minus cutoff. See here, this is this value, C star, that is cutoff point. Where we have found this value? Here, 8.697. Okay. See here, 8.697. This is my cutoff value. So I'll be using that in the problem now in order to find out Z1. So first stock I'll take. See students, there were 5 stocks in the problem. But when I'm finding the cutoff point, after finding the cutoff point, I got only 4 stocks. I need to neglect the 5th stock. Okay. The moment I get a value which is higher compared to the previous one, I need to stop there. Okay. So what I'm calculating now, the proportion of funds that has to be invested in the first 4 stock. So Z1 is equal to beta of the first stock, that is 0.99, divided by sigma A square of the first stock, that is 9.35, multiplied by Ri minus Rf divided by beta. Already we have calculated, that is 12.212 minus the cutoff point 8.697, that is 0.372. Okay. Similarly, Z2 is equal to 1.27. Okay, directly divided by 5.92 into 10 I get 0. I calculate for Z1, Z2, Z3, and Z4. That is 4 stocks. So when I summate this, I get 0.773. That is summation of Z1, Z2, Z3, and Z4. Now, I'll apply these values to calculate the proportion of funds that has to be invested in each stock. So how do I calculate the proportion of funds? Xi is equal to Zi divided by summation of I is equal to 1 Zi. Now, for the first stock students, what is the Zi value? 0.372. I'll apply 0.372 divided by 0.773. This value, total of that. Okay, which is equal to 0.4812. Similarly, for the second stock, 0.288, this value divided by 0.773. I got 0.372. Similarly, for the third stock, 0.111 divided by 0.773. I got 0.1436. Similarly, for the fourth stock, 0.002 divided by 0.773. I got 0.0026. Now, students, how to verify that your answer is correct? If you add all this, it should be how much? 100%. Okay. So if you add all this, say for example, 48.12 plus 37.26 plus 14.36 plus 0.26, it will be exactly equal to 100%. Okay. So the proportion of funds that has to be invested in each security should be, in first stock, it has to be 48.12%. And in the second stock, it has to be 37.26%. In the third stock, it has to be 14.36%. And fourth, it is 0.26%. So this is my optimal portfolio, which consists of only first 4 securities, and the proportion of funds is this. This is a problem which will be normally asked for the case study. Any doubt, students, please let me know. Or should I explain one more time?
Sir, please can you explain the CI column once again?
Okay, very good. Now, in order to calculate the CI, that is finding out the cutoff point, I use this formula. All of you know this, right? CI is equal to what? That is variance of the market multiplied by summation of I is equal to 1 to n, Ri minus Rf divided by sigma ei square into beta, whole divided by 1 plus variance of the market into summation of I is equal to 1 to n, beta I square divided by sigma ei square. Now, students, in my column already have calculated this part and already have calculated this part. I know the value. Okay. See here. 1, 2, 3, 4. Fifth column and sixth column, see here. Fifth column and sixth column. Fifth column and sixth column. I got for Anil 1.280, 4.015, 6.511, 7.332, and 8.258. Similarly, this column 0.105. For Avil, it is 0.377. For Viril, it is 0.649. And bow is 0.743. And finally, it is 0.67. So what I'll do, I'll use these values here in the formula. First, variance of the market. Sigma m square means variance of the market. They have already given to be equal to 10, right? Multiplied by summation of I is equal to this entire thing for the first stock is there in the table here. See here 1.280, which we have calculated 1.280. So my numerator, I am writing 1.280 whole divided by 1 plus 10 10 into this entire thing is there in the formula here. Sorry, is there in the table, that is 0.105, which we have calculated. So apply the same thing here, 0.105. This I need to calculate for the second stock, the third stock, the fourth stock, and the fifth stock. So I got for the first stock the value to be equal to 6.44. So how much it is? 6.244. Similarly, I request all of you to calculate for Avil, Viril, Bow, and Billy using this particular formula. Very simple. 10 multiplied by, for the second stock, it is 4.015. Okay. 4.015 whole divided by 1 plus 10 into 0.377. The values are there. Already we have calculated. Correct? And similarly for the third stock, what happens there? The CI value, the third stock is concerned, 10 multiplied by 6.511 whole divided by 1 plus 10 into 0.649. Similarly for the fourth stock, the cutoff point, that is 10 multiplied by 7.332 whole divided by 1 plus 10 into 0.743. Similarly for the fifth stock, CI is equal to 10, that is variance of the market, multiplied by 8.258 whole divided by 1 plus 10 into 0.867, which is equal to 8.540. Now, the moment I get a value 8.540, which is actually lesser than the previous value, in what way it has to be? It has to be in the ascending order. Please remember this. CI should be always there in the ascending order. Whereas Ri minus Rf divided by beta should be in the descending order. This should be in the highest to lowest. This is the first thing what we have to arrange. Then when we come here, it has to be in the ascending order. 6.244, 8.417, 8.693, 8.697. The moment I get a value which is lesser than the previous one, this will be my cutoff point. That is CI. So I will be taking only the stock from Anil, Avil, Viril, and Bow. I will not take Billy. So this is my cutoff point. So the moment I get a cutoff point, these four stocks will be there in my portfolio. So I need to include only these four stocks in my portfolio. Then after that, I use the proportion of funds. How much should be invested in these four stocks? Using xi is equal to zi divided by summation of I is equal to 1 to n into zi. So wherein zi, first I'll calculate for each stock, that is z1, z2, z3, and z4. So beta I divided by sigma ei square into Ri minus Rf divided by beta minus C star. That is the cutoff point. See, in each stock, when I'm calculating Z1, Z2, Z3, and Z4, I'm using 8.697 as my cutoff point. These values they have given. Beta is 0.99 divided by 9.35. Ri minus Rf divided by beta, already we have calculated here in the table. That is 12.212, 10.039, 9.190, 8.719. I'll use these values here in order to calculate Z1, Z2, Z3, and Z4. And summation of this will give me 0.773. And the proportion of funds xi is equal to how much? Zi divided by summation of I is equal to 1 to n Zi, that is 0.372 divided by this value. I get 48.12. Similarly for x2, x3, x4. So what are these? These are the proportion of funds that has to be invested in each security. Any query here in this problem, students? What we have done here? For David, we have constructed an optimum portfolio which will give him maximum returns and minimum risk. This problem is very, 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 very important. Any doubt here, please ask me. Can anyone explain how we have solved this problem so that I'll end this session today? Can anybody explain me how we have solved this problem? What was the first step? You can see the slide and explain me. No problem. Yes. Anybody? Any volunteers?
Sir,
Yeah, go ahead, ma.
sir, I'll explain this first part.
Yeah. Okay. Go ahead.
That expected. Okay.
First, what we have calculated?
First of all, we have calculated expected return for the securities, individual securities.
Hmm.
The formula is RI is equal to alpha plus beta market return, which is
Okay.
RM.
Hmm.
The first security is Anil, uh,
Okay.
equals to alpha, which is given in the problem,
Hmm.
3.72 plus
Hmm.
beta value is 0.99 into market return is 13.5, which is
Okay.
calculated after the it equals to 17.09.
Hmm.
And the second one is Avil, equals to alpha, already given in the problem, which is 0.60 plus beta 1.27 into market return 13.5 equal to the 17.75.
Okay.
uh, Next also we'll solve the same. Sir, should I explain to you all?
Okay. Any other student? Thank you so much, ma. The first part you have explained. Next, any other student? Come on, come on. Okay, you only continue then.
Okay, sir. First column, which is companies, are given Anil, Avil,
You just tell
Will,
me
and
what you have to do in the first step here.
okay. We have calculated the first column concern Ri minus Rf divided by beta.
Hmm.
Ri value is for the Anil 17.09
Very good.
minus Rf is 5
Hmm.
divided by beta value 0.99.
Very good. Now, how do we arrange this column actually after calculating
Uh,
Ri minus Rf divided by beta? Whether it has to be in ascending or descending order?
Descending, sir.
Very good. Very good. And
Yes, sir.
then after that, you got all this. How this cutoff point is found out, ma? CI value.
CI value. Yeah, sorry, sir.
Okay, no problem. No problem. CI value, the moment you get a value which is actually lower than the previous value, this is my cutoff point, that is 8.697. Okay.
Yes,
Oh,
highest is yes, sir.
okay,
Lower
then.
value will never not take anywhere, sir. It
Yes.
says.
Perfect. So after finding out the first stocks, what do you have to find now? The proportion of funds that has to be invested in each security, that is Z1, Z2, Z3, and Z4. So after finding out, I'll be going and putting these values into X1, X2, X3, and X4. Remember this, students, when you add this, it has to be 100%. Then only we can say that the portfolio is 100%. Clear? Okay. So what all we have understood here, so Markowitz developed algorithms to minimize the portfolio risk. Diversification reduces the unsystematic risk component of the portfolio. Then the level of risk exposure is measured with the help of a standard deviation of the returns. The expected return is the weighted sum of the expected returns of the portfolio, the weights being the probabilities of their occurrence. If securities with less than perfect positive correlation with their price movements or combined risk can be reduced considerably, the risk could be nil. We have seen this in the problem also. Or the standard deviation would be zero if two securities have perfectly negatively correlated. Risk cannot be reduced if the securities have perfect positive correlation. So many portfolios may be attainable, but some portfolios are attractive because they give more return for the same level of risk or same return with lesser level of risk. These portfolios form the efficient frontier. Then utility curves of the investor decide the most efficient portfolio. In the levered portfolio, investor is permitted to borrow and lend risk-free assets. They're also added with risky assets and it would remain minimize the risk. Okay, students, I will be continuing in the next session. Wish you all a very, very happy weekend. At the same time, whatever problem we have discussed, I request all of you to solve it today in your notes. Okay, so thank you so much to all of you. Take care.